At 9:15 p.m. in London, the British Prime Minister picked up a phone and heard a single sentence that ended an empire. The call came from Washington. The message was short, direct, and non-negotiable. If Britain did not leave Egypt immediately, its currency would be destroyed by morning. Within hours, British forces began preparing to withdraw from the Suez Canal. That was the moment power changed hands. A week earlier, Britain still believed it was in control. The Suez Canal was the artery of its economy, carrying oil, trade, and global influence through a narrow strip of water that London had guarded for generations. British leaders told themselves the canal was non-negotiable because losing it meant losing leverage, credibility, and control over the pound. And when Egypt announced it would nationalize the canal, Britain reacted the only way it knew how. It mobilized. Warships moved into position. Troops prepared to land. France joined the plan. The operation was clean, fast, and familiar. Britain had done this before, and it had always worked. But this time, something was different. The invasion moved forward anyway. British and French forces entered Egyptian territory, seized key positions, and announced they were restoring order. On paper, the operation was a success. The canal was under military control again. Shipping lanes reopened. The headlines in London sounded confident. Then the markets opened. Within hours, the British pound came under pressure. Foreign reserves began draining. Traders started selling. The Bank of England moved to defend the currency, burning through dollars to keep the pound stable. The numbers moved faster than the generals did. By the third day, the pressure was visible. Britain's foreign reserves were falling at a rate that could not be sustained. Oil shipments slowed. Insurance rates spiked. Allies began asking questions behind closed doors. And Washington stayed silent. Britain expected support. For decades, the United States and Britain had moved together. Military cooperation, intelligence sharing, financial alignment. That relationship had been treated as permanent. But this time, the call did not come. Instead, American officials began talking to the International Monetary Fund. They discussed emergency loans. They discussed currency stabilization. They discussed conditions. Then Washington made its position clear. No financial support would be given unless Britain withdrew. The message hit London like a second invasion. Without American backing, Britain could not defend the pound. Without defending the pound, imports would stop. Fuel would dry up. Food prices would spike. The economy would freeze within weeks. British leaders tried to buy time. They asked for delays. They asked for quiet coordination. They asked for room to finish the operation. The answer did not change. By the fifth day, interest payments on Britain's debt were climbing. Gold reserves were nearly exhausted. The Bank of England warned that another 48 hours could trigger a full currency collapse. The military situation no longer mattered. British troops controlled the canal, but Britain did not control its own money. Inside Downing Street, the decision became unavoidable. Staying meant financial collapse. Leaving meant humiliation. There was no third option left. The phone rang again. This time, the conversation was shorter. Britain would withdraw immediately, publicly, completely. Within hours, orders were sent. Troops pulled back. Ships reversed course. The operation ended not because of resistance on the ground, but because the financial system had closed the door. The announcement stunned the world. Britain had not been defeated in battle. It had been forced out by pressure it could not fight. The canal remained in Egyptian hands. Britain's allies adjusted their positions. The pound survived, but the illusion did not. In the weeks that followed, the damage became permanent. Countries that once deferred to London began negotiating elsewhere. Energy deals shifted. Financial influence weakened. Military reach no longer guaranteed economic security. Behind closed doors, American officials did not celebrate. They simply took note. They had discovered something new. Power no longer came from controlling territory alone. It came from controlling the systems that territory depended on: currency, credit, access. Britain had tanks, ships, and soldiers. The United States had leverage. And once that leverage had been used, it could never be unseen. From that moment on, every global decision ran through Washington first. Not because America declared it so, but because the system responded that way. Britain had entered Suez believing it was enforcing order. It left Suez knowing it no longer said it. The withdrawal did not calm anything. It triggered movement. Within days, shipping companies rewrote contracts that had favored British ports for decades. Insurance firms raised premiums on routes tied to London. Oil suppliers shortened payment windows. Each decision was independent, but they all moved in the same direction. Speed mattered now. Borrowing costs rose almost immediately. Treasury auctions slowed. Buyers demanded higher yields to compensate for uncertainty. What once sold out automatically now required incentives. Inside the Bank of England, reserve reports arrived with shrinking margins. Defending the pound had worked once, it would not work twice. Another shock would start another run, and this time there would be no pause button. That condition spread quietly. European governments noticed first. Defense budgets were reviewed. Overseas commitments were trimmed. Sensitive negotiations began routing through Washington instead of London. Not because anyone announced a change, but because approvals arrived faster there. If alignment mattered, it mattered through the same channel. The United States did not claim leadership. It did not need to. Decisions began passing through its systems by default. Loans cleared there. Guarantees depended on it. Stability flowed through institutions tied to American approval. Britain adjusted. Large interventions disappeared. Commitments narrowed. Global presence shrank without ceremony. The empire did not collapse in a moment. It thinned contract by contract, deal by deal, deadline by deadline. Washington paid attention. What mattered was not Britain's mistake. What mattered was how fast pressure worked when it targeted money instead of soldiers. Occupation took months. Financial pressure worked in hours. That speed changed everything. Over the next decade, the structure expanded. More trade settled in dollars. More reserves were held in American assets. More institutions tied access to stability through Washington. No one framed it as dominance. It was framed as efficiency. Countries opted in because opting out was costly. By the 1970s, the shift was complete. Britain was no longer the place decisions passed through. The United States was. Even when no one said it publicly, behavior confirmed it. The system worked, which encouraged its use. Trade accelerated. Capital moved faster. Markets deepened. Confidence became automatic. Commitments grew under the assumption that financing would always be available. By the 1990s, scale became protection. Trillions moved daily through financial channels tied to American oversight. When disputes emerged, access replaced invasion. Sanctions replaced occupation. Pressure replaced presence. Each use reinforced dependence. Each success encouraged repetition. And then repetition created exposure. Competitors adjusted slowly at first. Longer contracts replaced spot trades. Bilateral settlements replaced centralized clearing. Reserves diversified incrementally. None of it triggered alarms because none of it looked dramatic. It did not need to. Each adjustment reduced reliance by a fraction. Each fraction mattered. The system still dominated, but exclusivity weakened. Washington responded the way it always had. Pressure increased, sanctions expanded, access narrowed, compliance windows shortened. The logic stayed intact. Dependence would force alignment just as it had before. For a while it worked, but the environment was no longer the same. Debt levels were higher. Political coordination was weaker. Global trust was thinner. The margin Britain lost in 1956 now existed everywhere at once. The structure had grown dense. Every use of leverage now produced countermoves. Every countermove reduced flexibility. Each cycle raised the stakes. By the mid-2010s, signs clustered. Settlement delays increased. Reserve drawdowns accelerated. Financing costs crept upward. None of it caused panic. Panic requires surprise. This was gradual. The system still functioned, but it required constant motion to stay balanced. Markets expected continuity. Allies assumed support. Any hesitation would be priced instantly. That expectation became a trap. Britain had faced pressure and withdrawn. Britain had conceded territory and stabilized. Britain had an exit. The country now holding the center did not. Walking away would fracture the system that financed its commitments. Staying meant absorbing every shock that moved through it. There was no clean option left. Deadlines shortened. Margins thinned. Consequences multiplied. The same mechanism that ended Britain's control of Suez still worked. The difference was scale. This time, the leverage pointed inward. And once pressure starts moving that fast, no leader gets to slow it down. Washington did not declare power. Washington restricted access. After Suez, dollar payments began slowing without warning. Banks waited longer for clearance. Trades missed settlement windows. Deals that used to close in hours now dragged into days. Governments noticed the delay immediately. Fuel shipments arrived late. Insurance approvals stalled. Importers missed deadlines and paid penalties. The paperwork still existed, but timing no longer obeyed expectations. Responses followed fast. Reserves moved. Contracts shifted. Payments rerouted through channels that cleared faster. Every adjustment pointed toward the same solution. Stay inside the dollar lane. By the early 1960s, most energy trades settled in dollars. Suppliers accepted it to avoid delay. Buyers accepted it to avoid disruption. Speed mattered more than preference. Volume exploded. As volume grew, clearing paths narrowed. Fewer institutions processed more trade. Those institutions answered to American rules enforced on American time. Reaction windows shrank. When disputes appeared, financing paused first. Insurance repriced next. Shipping schedules slipped after that. Governments reacted last when markets had already moved. The order stayed consistent. Money paused. Markets adjusted. Decisions followed. By the 1970s, alignment became routine. Countries holding dollar reserves gained stability. Countries operating outside absorbed volatility. Exchange rates reflected the gap daily. Capital moved towards certainty and away from friction. The shift accelerated. Reserves increased. Enforcement softened. Compliance required no threat because deviation cost more than participation. Then scale changed the balance. Debt expanded. Guarantees multiplied. Military spending assumed uninterrupted financing. Demand for access was treated as permanent. For decades it was. Through the 1980s and 1990s, capital moved faster. Clearing sped up. Settlement windows narrowed. Systems rewarded scale and punished delay. Pressure became efficient. When conflict surfaced, access tightened. Credit shortened. Assets froze. Markets reacted before officials spoke. Outcomes arrived quickly. But repetition created exposure. Each enforcement action revealed entry points. Each freeze mapped dependencies. Every restriction taught others where pressure landed. Adaptation followed. Bilateral trades increased. Long contracts replaced rollovers. Reserve holdings diversified slowly to avoid attention. Each move looked harmless. Together, they mattered. By the early 2000s, leverage remained strong but slower. Pressure still worked but required reinforcement. Compliance stopped arriving automatically. Washington responded. Sanctions expanded, conditions increased, review periods shortened. Enforcement became visible because quiet pressure no longer delivered results. Visibility triggered resistance. By the 2010s, alternatives existed at the edges. They were slower. They were inefficient. They were usable. That changed behavior. Markets priced optional paths. Governments delayed commitments. Trade groups tested parallel routes during calm periods. The center reacted. Access tightened again. Compliance checks multiplied. Penalties escalated. Speed remained the objective. Scale created risk. Debt reached records. Deficits widened. Financing depended on uninterrupted flow. Any pause threatened rollover schedules measured in days. Deadlines moved inward. Unlike Britain at Suez, withdrawal was impossible. The structure depended on constant motion. Enforcement now risked damaging the system that enforced it. Markets sensed the constraint. Settlements slowed. Reserve drawdowns increased. Insurance spreads widened. Nothing collapsed. Gradual shifts rarely panic markets. By the mid-2020s, timing replaced authority. Pressure still worked, but windows narrowed. Errors traveled faster. Recovery space vanished. The same mechanism that forced Britain to retreat now operated at a scale that could not step back. Access still existed. Leverage still functioned. Deadlines still forced action. The difference was position. Britain exited the canal and stabilized. The center could not exit itself. The pressure engine stayed active. The margin for error disappeared. And every decision now ran on a clock no one fully controlled. In early 2026, the first problem did not appear on television. It appeared on a schedule. At 8:30 a.m. in Washington, Treasury officials opened bids for a routine bond auction that had cleared smoothly for years. The amount was large but familiar. The expectation was simple. Buyers would show up, rates would settle, and the day would move on. The bids came in late. Phones started ringing inside the building before the final numbers were posted. By the time the auction closed, yields had jumped past the range officials expected. The demand was there, but weaker. The margin was thinner. The explanation was postponed. 2 days later, another auction opened. This one mattered more. Existing debt was rolling over and payments were due on schedule. There was no flexibility built into the calendar. This time, the bids arrived slower. By noon, senior officials were in a closed room reviewing screens that refused to improve. Buyers were still present, but they wanted higher returns. Every adjustment raised the cost of keeping the system running. A call went out to major banks. The response was cautious. Desks would participate, but not at previous levels. Risk teams had already adjusted limits. The math no longer worked the way it used to. That afternoon, the decision was made to apply pressure somewhere else. Licenses were delayed, approvals slowed, access tightened. The move was quiet but deliberate. The expectation was familiar. Compliance would follow once friction appeared. Instead, another deadline arrived. By the end of the week, refinancing costs had climbed again. Budget teams flagged the increase. Defense commitments stayed fixed. Social programs stayed fixed. Interest payments did not. There was no announcement. The numbers spoke loudly enough. A foreign central bank reduced its purchases at the next sale. Another shortened maturities. No one made a speech. They just changed behavior. Inside the Treasury, a new calculation replaced the old one. Holding leverage required constant motion. Pauses created gaps. Gaps invited cost. Another tightening followed. This time, the reaction came faster. Prices moved against American assets before the day ended. Traders adjusted positions. Hedge funds stepped back. Liquidity thinned. A senior official asked for options. The list was short. Rates could rise again. That would stabilize demand but increase costs immediately. Spending could be reduced. That would trigger political fights before an election year. Pressure tools could be expanded. That risked accelerating the same response already forming. No option bought time. On Monday morning, another auction opened. This one cleared, but barely. The rate locked higher than any forecast from 6 months earlier. The adjustment was absorbed quietly, but it changed the slope of everything that followed. Debt servicing costs rose. Forecasts were revised. Commitments stayed the same. Markets noticed. The next response did not come from Washington. It came from abroad. Two trade settlements moved outside traditional channels. A commodity contract priced differently. A financing agreement cleared through an alternate route. None of it was dramatic. None of it was illegal. It was simply easier. By mid-year, the pattern had formed. Every attempt to enforce leverage produced an immediate cost. Every cost narrowed future options. Every narrowing reduced flexibility. The system still worked, but only if nothing interrupted it. Then something did. A political standoff delayed a budget vote. Payments were authorized late. Markets did not panic, but they adjusted. Adjustments raised rates again. Inside the Treasury, officials tracked the curve flattening in real time. Each point represented billions over the next decade. The numbers no longer bent back. Pressure was applied once more. This time, the response was muted. Partners complied publicly and adjusted privately. Access remained, but enthusiasm faded. Participation slowed. The leverage still existed. It just no longer landed cleanly. By autumn, the calendar was unforgiving. Rollovers stacked, payments aligned. There was no moment to reset without consequence. Britain had faced a similar choice once. It stepped back. America could not. Stepping back meant disrupting the very structure holding everything together. Staying meant absorbing rising costs with shrinking room to maneuver. There was no phone call to make, no withdrawal to announce. The pressure that once forced others to move had turned inward. Deadlines kept arriving. Bills kept clearing. Rates kept rising. The system responded exactly as it always had, just not in the direction anyone expected. And for the first time since Suez, the country at the center learned what happens when leverage has nowhere left to go.